Thanks for joining, Leah and Jeremy.
You're welcome.
Maryland. And I'm joining all the way from Charlotte.
And we got Miles joining in from Memphis, Tennessee. Kayla from North Carolina, Charlotte.
It's Charlotte, North Carolina, dude. What's your problem?
I'm sorry, sir.
Thank you. Don't be messing around our city.
And we got Mike from Columbia, South Carolina.
Nice, Mike. Thanks for joining.
Dotun from Brooklyn, New York. Welcome, welcome. We got Claude from MD, Fort Washington. Welcome, Claude. How you doing?
All right, Leslie, what time is it now? It's 6:05.
Yeah, so we're gonna get started. We got Christianus from Lagos, Nigeria. Man, we got people from all over the world, and we got Afu Adek joining from Frederick, Maryland. Welcome, everybody. Welcome to the exciting world of multifamily investing. Tenny, are you ready to go?
Yeah, ready to go, man. Ready to kick it off. Let's do it.
All right. Chima is joining in from Oyo, Nigeria, man. We got the whole world here today. It's going to be an exciting Monday. Welcome, everybody, to the exciting world of multifamily investing meetup. This is a meetup hosted by Excite Capital on behalf of our CEO, Dr. Julius Oni, who is traveling internationally and could not be here with us today. Our entire team who are on this call today, Kayla Daughtry, Miles Hill, Mike Dawson, Chima, Caleb, and our Director of Acquisitions, Mr. Tenny Tolofari, and myself would like to say welcome to the exciting world of multifamily investing. So the topic today is multifamily dead? I'm going to stop right there and I'll pass it over to Tenny Tolofari, our Director of Acquisitions.
Thanks, Leslie. Again, thank you all for joining. And that's a good question. A lot of people are asking, I had an investor reach out to me recently. I was asking me, is this a good time to buy multifamily real estate or any kind of real estate at all? So today we're going to be going into some significant details about what's going on in the market so that you guys can kind of be abreast of what's going on in the market space right now. Next slide, please. So the question is, multifamily real estate dead? All right, so we have a disclaimer. This presentation is for educational purposes only. We always advise that you seek counsel if you want to do any kind of investment or you want to invest in any kind of securities. Make sure you seek counsel. But what we're doing right now for educational purposes only. So these are the three founders of Excite Capital, leading with the CEO, Dr. Julius Oni, who is the CEO. Like Leslie mentioned earlier, he's traveling. We have Leslie Awasom, who's the Director of Operation, represented here, and then myself, Tenny Tolofari, Director of Acquisition. So we're here to provide some insight about what's going on in the space. Before we go in and share more significant details, we're a private equity firm. If you've not heard about us before, a private equity firm that is focused in acquiring large apartment buildings. Currently, we have about $168 million of assets under management. And we're continuing to work on deals, continue to understand the market space. And that's why we're here right now, to kind of share some of those insights with you all on what we're seeing in the market space currently. Next slide, please. All right. So the discussion that what we're going to be focusing on is going to be on three different aspects of, we're going to be focused on three different aspects in our conversations today. One is understanding the risk of investing in real estate or multifamily real estate, and also exploring foreclosures and capital calls in multifamily investing. We're going to be talking about what is capital call. Now, a lot of people have heard about capital call. What does that really mean to me as an investor? If I'm an investor, what does that mean? And then if I'm an operator, what do I need to do in order for me to protect myself? And that's what the investor protection strategies come into play. So we're going to talk about some of the things you as an operator, you have to be thinking about. And then as an investor, you have to be thinking about when you want to invest in a deal or in a multifamily real estate deal. And also we're going to be talking about how to navigate troubled waters. How do you manage foreclosure risk and financial challenges in the current economic climate and in our current in the current market space currently. So these are some of the things we're going to be sharing some more insights to. Please bring out your pen and paper. And then if you have questions, please do not hesitate to kind of drop it in the chat. And we're going to make sure we answer a lot of those questions as we go through it. So 1, exploring foreclosures and capital calls, understanding the risk. Can I get the next slide, please? All right, so foreclosure, capital calls. So what's foreclosure, right? Basically, foreclosure is you're not able to pay your mortgage and the bank takes over the property. That's foreclosure. And a lot of times, in order for multifamily operators to avoid foreclosure, they do what's called a capital call, right? Now, in today's climate, what we've observed is a lot of folks bought a lot of deals during 2019, 2020, 2021, and the early part of 2022. There was a lot of deals that were bought using bridge debt, and a lot of those guys were really aggressive on their deal. There's this thing called the 3 irrevocable law of real estate. A lot of the people that was buying real estate at the time, they were not following those laws. And if you want the answers to what those laws are, just put a chat in the question and say, I'm interested in knowing what those laws are. And then I'll share those laws with you all. But a lot of those operators did not follow those laws. And right now, what we're seeing in the market space is there's been a lot of capital calls in the marketplace in order for them to avoid foreclosure. I know people are asking what it is. Don't worry, I'll give you the answer later. I'll Google it and give you the answer. Yeah, let's go to the next slide, please. But those laws are basically, if you want to buy a deal, you want to buy for cash flow. You want to make sure any deal that you buy from day number 1 is cash flowing. And then the rule number 2 is you want to buy for long-term debt. You want to make sure when you're buying the deal, you're securing it with a very, very, very long-term debt, so that we don't see what we're seeing right now. And then the last one is you want to make sure you have adequate reserve. That means you want to make sure you have about 2 to 3% of the total price of the property in a bank account, whereby if something happens, you can dash to the bank real quick, grab that money, and then you can use it to kind of save the property. So when we talk about foreclosure, there's a lot of things that can happen when you're thinking about foreclosure. One is financial loss. A lot of investors right now, they're in a position where they have the possibility of losing their capital. And one thing that Excite Capital is very keen on is capital preservation, right? If I invest $100,000 and the operator that have the property is not able to service the debt, the bank is going to come and say, hey, listen, you're not able to service the debt. You're not a good operator. Give me the property. And in that case, the bank will take it and go foreclose it. What happens in that situation? 1, you, the investor, you lose your money. And then 2, the operators, they lose their reputation in the market space, especially if you're working with like a lot of these banks out there. So a lot of operators currently are trying to save face. And because of that, they're trying to prevent that, and they're doing what's called a capital call. And I'm going to share some more light about what we're seeing. Actually, there was a note that I received recently about a particular deal in North Carolina that they're calling for capital call, and this is what they basically said. They said, if you don't invest in this deal right now, or if you don't bring additional money in this deal right now, these are the 3 possibilities. One is capital infusion, right? We have to put money into the property in order for us to survive, to kind of revive the deal. What does that mean? It means that the current operation on the property, they're not able to service debt, and they are going back to the investors to ask for more money. And if you as an investor, you don't put in any money, you have a chance. There's a high chance that you will lose your principal, which is basically you putting your money and your money just possibly go down the drain. The other option is a sale of the property. They are saying that if the property goes, if you don't put any money on the property, they are going to just sell it. And if they sell it, they're going to probably sell it for loss. Probably they're going to sell it in a situation whereby they're just paying off the debt. And now all the equity that you brought in on the deal, all of that is gone. Remember, if you're buying a deal, the bank gives you a certain percentage between these days around 65% leverage we're seeing. So the bank gives you 65% and you have to raise the remainder of it. And that money usually comes from investors. Now, if you have a situation where you're distressed, all you're thinking about right now is, let me just pay that 65% debt. And if you just pay that, everybody washes their hand and go. And then the money that you raise from investors, everybody lose their money. And then the last one, of course, is foreclosure, like we've been talking about. So they are saying every investor on this particular deal needs to bring 20% of the total investment. What does that mean? You have $100,000. That means you need to bring 20,000. And if you don't bring it, they put you back down on the list. Everybody that brings money as part of the capital call, if for any reason they have to give back money back to investors, those are the guys that are going to give before they give you. And then right now, another opportunity that we're seeing with this capital call is what's called preferred equity. Preferred equity right now is huge in the market space currently. A lot of people are using it to build their deals. What does that mean? It means on the capital stack, what a capital stack is who get paid first when we receive, when revenues get generated from the property. The highest stakeholder on the property is the bank. Because remember, they give you like they give you all the way up, sometimes all the way up to 85% leverage on deals. So those are those guys that have the highest chunk, right? So they get paid first in the capital stack. If a preferred equity comes in, the preferred equity gets the second space. That means it's money coming, you pay the bank, the preferred equity get next, and then you, the limited investors or limited partners, get the last. So a lot of people are trying to avoid it, but if they cannot get money from a capital call, a lot of them go to preferred equity. And preferred equity gets up in the capital stack, and their requirement is pretty stringent. And like I mentioned earlier, reputational damage is a big piece of this as well, where if you're not able to service your debts, you're not able to operate your property right, you lose it, and then you kind of put the dent on your reputation. So that's what a lot of people are trying to avoid currently. So next slide, please. And I'm going to ask a question about what the 3 irrevocable law of real estate is at the end of my presentation. So make sure you're paying close attention. All right. So what are some of the risks associated with capital calls? We call financial strain. Unexpected need for additional fund can strain investor finances. For example, if I invested $100,000 and now somebody just calling me off the blues, I'm like, hey, listen, Tenny, I need $20,000. Where am I going to get $20,000 from? I just have to cough out $20,000, right? So that is kind of putting a lot of pressure on a lot of investors. And in some instances that I've seen too, they have investors that have up to $500,000 to $1 million on a deal. So now imagine that they're asking you to bring for $500,000, they're asking you to bring $100,000, right? Now, if you don't have that money, you have a high chance of losing your initial principal. So that is the huge strain on capital call. Dilution of ownership. Like I mentioned earlier, when you have the bank and then you have the preferred equity coming, that automatically dilutes everybody's return. So if they were projecting a 20% or 15% average annual return, that would automatically reduce. And sometimes in some cases, if you get your money back, you're lucky. They just probably just give you your initial principal. So these are some of the risks that's associated with capital call. Next slide, please. All right, so these are new. This is just the beginning of it. Now we have news off in San Francisco, in Dallas, and we know there are some big names that we used to hear in the space. Some of them are in the news already. And a lot of these properties are beginning to go into foreclosure. On the left here, you have a lender moves to foreclosure on a Stafford apartment complex after $288 million loan default, right? And this is just one. We have a deal right now that we are underwriting. As of 2022, they refinanced that deal or got a fresh debt on that deal for they acquired the deal for $70 million. And the debt on the deal is about $57 million, right? So currently, as I speak to you right now, the owner of the property wants to sell it for $57 million, which is they're just saying, if you're able to buy this deal and take it off our hands, just give us the debt amount of money. Let's just give it to the bank. That means the difference between 70 and 57, all the equity that was brought into the deal, all of that is gone. And that all of those are investors' principal that they brought into the deal. So now, as I speak to you right now, we're underwriting that deal to try to see if we're able to make something out of it. So as we continue on this, we're going to talk about how does this switch into opportunity? And those are some of the insights that we're going to be sharing with you all. So we have impact on investment, reduced return, increased risks, and potential loss of your principal. So this is what we're seeing, and this is just the beginning. Towards the middle and end of this year, we're going to continue to see a whole lot of these news on the news where a lot of properties are getting disclosed, or preferred equity is coming in and taking a higher stake on the capital stack. Next slide, please. And then I'll pass this on now to Leslie to go about the investor protection strategy that we're seeing and that we're implementing at Excite Capital as well.
All right, great. Let me try to match your energy, Tenny. All right, so this is an interesting time in multifamily investing, which is why the presentation was appropriately titled "Multifamily Investing Dead?" And like Tenny greatly illustrated, there's a lot of turbulence in the market right now, and it's actually just the beginning of this cycle that we're seeing, right? We're going to see a lot more assets that are getting distressed, a lot more assets that are going to go into foreclosure. And like Tenny explained, one of the primary reasons for that, which I'm going to dive into more, is a lot of these business plans did not follow those three immutable laws of real estate investing, which is buy for cash flow, secure long-term debt, and make sure that you have adequate reserves. Now, having those three pillars in place when you go into every investment significantly decreases your chances of ever having any issues with your investment to almost to zero, right? But having just one or two of those pieces in place is equally just as strong to help you in case of any kind of distress like we're seeing right now. So here are some investor protection strategies for the assets. If I can move to the next slide. All right. So steps you want to use to protect your investment, right? As a passive investor, before you invest in an asset, make sure you vet the sponsor group, right? Conduct thorough due diligence on the sponsor group, including their track record, experience, and reputation in the industry. And not just reputation in the industry, reputation in their professional careers as well, right? Evaluate the sponsor's investment strategy for alignment of interest with the investors and risk management practices. What we are seeing, right, and what we're seeing in the market right now, there are a lot of other experienced investors that are going through some of the same issues. And just to give some background how this all came about is back in 2021 and with COVID, the Fed dropped interest rates down to zero. With interest rates being down that low, the traditional lenders who typically give out long-term debt on multifamily asset, which is Fannie Mae and Freddie Mac, decreased their leverage that they were giving out. They decreased the leverage, typical leverage in multifamily assets, that's the amount of the debt as a percentage of the price of the asset, used to be about 70-75% prior to the drop in interest rates. But with the drop in interest rates, prices went up. So Fannie Mae became more stringent and they decreased that leverage to about 60%. Now, in came other lenders, smaller banks, and you hearing about some of these banks collapsing, Silicon Bank, yelling about Bankrupt Group in New York that is all in trouble right now, that might be collapsing soon as well. So these smaller lenders came in and started issuing out loans for multifamily assets, but the loans they were issuing out are called bridge loans. These are loans that are typically given out to short-term business plans like development or like a total repositioning. But because there was so much money out there and it was available to operators, operators started going after the bridge loans to apply to traditional multifamily business plans. And part of the motivation behind that was the Fed kept saying they do not envision any interest rate hikes in the near future, right? And every curve that you could look at that point in time was saying even if interest rates could go up, it's probably not going to go up past a certain level. So most of those business plans were done with an interest rate peaking at about 5 or 6%. But we all know what happened. Inflation went out of hand and the Fed had to do something about it. So they went on an interest rate hike spree, unprecedented in history. No expert ever saw it. But what that happened is like these operators that bought deals with the floating rate debt, when the cap that they had on their interest rate expired, their debt cost increased. So you had somebody that was estimating an interest rate hike up to 5%, now having an interest rate on their debt of 9%. So that's almost doubling their debt service. That's the debt requirement. And that completely eats into the cash flow. In addition to that, in some of these markets, insurance prices triple. So you having like everything going wrong to affect the bottom line, right? So now, how does having the three immutable laws of real estate investing would have protected investors in this scenario? Number one, if they had bought for long-term debt, even at a 60% leverage, and that debt will still be in place right now, all the fluctuations in interest rates will not affect that debt. Number two, having enough cash reserves deals with any situations like when insurance prices go up more than what you're expecting, and that protects you and protects your investors. So these are some of the things that you want to make sure that your sponsor is putting in place, right? And when you're looking at a sponsor group, look at what their motivation is behind getting into the space. Don't just go to a sponsor because they're promising high returns. You want to invest with sponsors that are conservative, that are very conservative in their projections, because it's better to under-promise and over-deliver than to over-promise, and then you end up in a situation where you have to go to a capital call. As an investor, you want to implement a diversification strategy. The great thing about multifamily assets is it's truly a diversified investment, which means the assets are not correlated to each other. So as an investor, invest across different markets. Do not put all of your funds into one deal. Invest in different deals, because the way things happen in one market does not necessarily affect what happens in the other market. And I'm going to illustrate an example of this with our own assets, how they perform differently in this climate. You know, like we're going through like a recessionary kind of period right now in most markets when it comes to multifamily. But you would see that it manifests itself differently in different markets. So for our investors that are invested in all of our deals, you can see that diversification protects them because they continue to get returns on their investments. So you want to consider investing in assets in different markets, invest in different classes of assets, because some of them might be a little higher risk with a higher return, while some of them might be more lower and a more stable return, right? You want to conduct regular portfolio reviews. Reach out to your sponsor. You want to know how your property is performing. A lot of multifamily operators will send updates on property, financials, and all of that. Read those documents, understand the trends, right? And it does not necessarily mean if things are not right where it needs to be at that point in time, everything is going bad. You want to understand what the operator is doing to stabilize that. Is that in line with the business plan? What's going on? Is communication open and clear? You know, so you want to keep track of your portfolio and review how it's performing on a constant basis, and adjust your portfolio strategy based on the performance of these individual properties and overall market conditions. Stay informed. Stay informed and educated. Regularly monitor the performance of your multifamily investments. Like I said, you get this report every month. Read it because it helps you understand how your assets are performing, and it also helps you. It gives you that knowledge base to make the right investment decisions when you go to invest on another asset in the future. Now, let's go into navigating these troubled waters, turning distress into opportunity. Is multifamily dead? No. Multifamily is certainly not dead. And like one of the most famous investors says, the best time to buy is when there's blood on the streets. And I could tell you guys right now that over the next 12 to 18 months, there's going to be a lot of blood on the streets for multifamily. But now is the time to jump in the market and buy assets at significant discounts, discounts that we have never seen in the multifamily space, right? If you look back to 2009, 2010, in the residential real estate space, what happened with the real estate market crash? That is similar to what most experts are saying we're going to be seeing in the multifamily market. And we are already seeing it with the deals we are underwriting. We are seeing same deals that we looked at 12 months ago are now 40%. discounted. And even at those prices, it still does not make sense with our underwriting. We're having to pass on these deals because the numbers still do not make sense. And some of these deals are deals with great fundamentals. When I'm talking about fundamentals, I'm talking about deals in great markets, right? Markets that have a 10-year, 20-year growth projection plan, markets that people are moving into. These are deals that have good bones, no serious structural issues, right? But just because of the cycle that we're in the market, they might be going through a little bit of a struggle. And then added to that, the operators took a lot of risk on the debt side and the reserve side. So now they cannot maintain those assets. They have to exit out of those assets. So now is the time, as a savvy investor, to go in and take advantage of the blood that's on the streets and buy these solid assets. These are assets that you hold for long term and create generational wealth for yourself and your investors. So let's get a good understanding of the market cycles. So like anything, like any other investment, the multifamily market goes through cycles, right? So as a passive investor or even as an active investor, it is important that you have a good understanding of what these different market cycles represent, because your investment strategy in every cycle is different. Right now in the United States, most markets are in either the hyper supply phase or in the recessionary phase. A few of them are in the recovery phase, and a few other tertiary and secondary markets are actually in the expansion phase. So you would notice that at every different point of the market cycle, like, the investment strategy might change a little bit. For example, right now, with most primary markets being in hyper supply and in recession, secondary markets and tertiary markets are more on the expansion side. So those might be great markets to get into at this point in time, so that you get in and you're still able to cash flow and your asset grows, right? So you want to recognize the market downturns. So it goes through, there are four main cycles, right? You have the recovery phase, the expansion phase, the hyper supply phase, and the recessionary phase. Just quickly on what these different cycles represent. Uh, Recovery phase is when you see like declining vacancy. That is when there's no new construction coming in the market, so the available units are getting occupied. That means the market is recovering from this other phase of hypersupply and recession. Now, after the recovery phase, you move into the expansion phase. The expansion phase is where most markets in or multifamily markets in the US was in over the last 4 to 5 years. This is where you see declining vacancy, occupancy is really high, rents are skyrocketing. Everybody is happy. Everybody is talking about multifamily. Everybody's making money in multifamily, right? But every peak, there comes a downturn. So now, with that increase in demand and declining vacancy, cities start issuing out new licenses for new construction. So you have like new units now start coming in the market, right? And then the market gets overbuilt, and then we go into hyper supply. And this hyper supply is usually coincides, interestingly enough, with like a recession in the economy, where you have too many units in the market. Then that same market as well, there might be some struggles with the job market and everything. So you start seeing an increase in vacancy. That's when you start seeing a lot of concessions. If you're a tenant, if you're a renter, this is a good time to go rent an apartment. That's a tip. Go to a market that's in hyper supply, and you can negotiate any price at that point in time, because you get into a brand new apartment building for 3 months off. So when you start seeing that advertised in markets, know that market is in a hyper supply phase. And that is what is happening in a lot of the primary markets. They're overbuilt and now they're in hyper supply. So you're seeing a lot of concessions. And then now that goes into recession, right? Because you have more supply than demand. So, but when the market gets into a recession, that is the best time to get in. Because remember, these assets is not a flip that you're going to hold for 6 months and sell. These assets, the average business plan is about 3.5, and it can go up to 7 years. Now, it is those period of time that you could capture a significant amount of value. Because if you know how multifamily assets are valued, when you leave from the recession phase and you buy this asset at a lower value, and then you go through the expansion, experience that rent growth, like what, and exit out somewhere around the expansion cycle, you create a tremendous amount of wealth for yourself and your investors if you're an active investor. Or if you invest as a passive investor into a deal in this time, you create a significant amount of wealth for yourself. So now is the time to seriously get into multifamily investing because of the distress that's coming to market and because there are really great opportunities that are coming. So here are some strategies for identifying great opportunities. You want to conduct thorough due diligence. Make sure that the numbers that are being represented by the seller or by your by the GP or the sponsor are actual numbers that represent the economic status of that particular market. And some of these things you can easily verify if a general partner or an operator is telling you you can invest in this deal, the rent in this market at this or that. You can quickly verify that yourself by just doing a quick search on apartments.com, and you'll be able to see some of those numbers yourself and make sure that it makes sense. You want to look for properties that are in desirable locations with strong rental demand. Ask questions about the market conditions. Ask questions about the new supplies that are coming to market. Ask questions about the rent projections. Ask questions about the three immutable laws of real estate investing. What kind of debt do they have on the property? How long is the debt? Right? What kind of reserves are they baking in during the hold of the property? Are those reserves enough to deal with any kind of challenges that come along the way? And does the property cash flow from day one? Right? Is this property making money from day one? Not saying now the cash flow piece for like a deal that might be like a distressed asset, which we're going to see a lot of those this year. They might not cash flow for year one, but is there a cash flow story? Is there a path to that cash flow that you can accomplish over the next 2 years? So the cash flow piece, like I said, if you have 2 out of 3, that significantly decreases your risk. Now you might get a distressed asset that's not cash flowing year one, but then over the next couple of years it starts cash flowing, and then you get a significant amount of growth from that. In those kind of assets, you want to make sure you have a good long-term debt and you have adequate reserves. And one great tip in this time: look into secondary markets, look into tertiary markets, because a lot of these markets did not get overbuilt with the boom that happened over the last 4 years. A lot of these markets do not even have any supplies coming to them, but you still have people moving to these areas because of the expensive nature that a lot of these cities have gotten to. So these smaller markets that surround major cities are good places to invest in, because a lot of people moved out there as long as they could commute to the city so that they could get affordable rent. So you want to look for affordability, and you're going to see that in a lot of secondary and tertiary markets going into this season. So how do you mitigate risk while you pursue opportunities? All right. So you want to make sure that you're implementing good risk management strategies to protect your investment during this volatile period, right? Cash reserves. Cash reserves are king, right? Having enough cash reserves can get you through any cycle, can let you weather any storm. Because whatever we're experiencing right now, it's a very, very small moment in time. Unfortunately, for the investors that are losing their money, it's a big deal, right? Somebody is losing their life savings because they invested in a deal, and things did not go as planned, But from the grand scheme of things, this is a very, very small, short period of time that this we go into this distress, right? So even if you're an investor and you're in one of those deals, do not let the negativity of the particular situation prevent you from capturing good opportunities that are going to come up in this market. So now might actually be the time to diversify into some of these other deals that are coming to market, so that you could cover from some of the losses that you're experiencing. So liquidity again is king. Make sure that your sponsor has enough liquidity to deal with any challenges that come along the way. If not, you might be forced to do some capital calls. So is multifamily real estate dead? Absolutely not. And here are the reasons why. Multifamily remains high in demand. Despite all the buildings that have come into the market recently, there is still a significant shortage of multifamily assets across the US, and we cannot build enough fast enough to deal with that. Now we have a population that is living much longer, right? that is living much longer. And a lot of the baby boomer generation are downsizing from their houses to smaller apartments. So the need for these apartments continues to increase because of demographic trends. Income stability, when managed properly, when the three immutable laws of real estate investing are in place, you have an asset that provides stable income to you as an investor. These assets are recession resistant, right? We witnessed that with the COVID and everything that was going. Why the stock market crashed during COVID pandemic, multifamily assets kept increasing in prices. And the reason why they're recession resistant because they provide a core human need, right? Which is the need for housing. And as long as people always need a place to stay, these assets are always going to be needed. There's like a tremendous opportunity for long-term appreciation. Again, remember what I said. The distress that we're going through is a small moment in time, right? That's why long-term debt is so important, because within that 5-10 year period that you're holding your asset, there might be 18 months of distress in there, right? But having a stable, good debt in place gets you to weather through that storm, right? And you come out on the other side to gain some significant appreciation. So again, there's a strong opportunity for long-term appreciation when it comes to multifamily assets, and then investment diversification. Ray Dalio calls what he calls the holy grail of investing is diversification. And by diversification, he means investing in assets that are not correlated to each other. And he says if you have like 8 to 12 of these investments, it significantly increases your returns and decreases your risk by what is it, like a factor of 7 or something like that. And actually, Tony Robbins actually wrote a book about this strategy of diversification, where you're investing in assets that are not correlated to each other. A multifamily is a great asset that is not correlated to. It's a great way to diversify in an asset that's not correlated to the other. Okie doke. And so despite market fluctuations, multifamily real estate has proven to be a resilient and reliable investment option. So now is the time again to start looking at multifamily if you've never invested in multifamily. Here's a good example of what a diversified portfolio gets you. Now, this is the assets that we currently own and manage as Excite Capital. Across these assets, we have a couple of assets on here where we currently not issuing out distributions because a couple of them were like distressed assets that we bought and which in the stabilization period. But guess what? The other assets that we have are still getting distributions. So while we're building and stabilizing the other assets, the ones without distributions, to get them to appreciate in value, the investors, some of our investors that have invested in all of these assets, continue to get their cash flow from the other assets that are more stable and now are building appreciation on the distressed assets with the stabilization plan that we're putting in place. So a diversified portfolio protects you from any kind of changes in the market because you're still able to get good return and continue to grow your investment over time. On that note, that's all I got so far. And on behalf again of our CEO, Dr. Julius Oni, myself, and my co-founder, Tenny Tolofari, and our entire team here at Excite Capital, we want to thank you for sticking with us and joining us this evening. And I guess, Tenny, we're opening up for questions right now.
Absolutely, absolutely. This is the time for us to engage. If you have questions, please feel free to unmute yourself and then ask your questions. And hopefully we can provide some good answers to it. So again, multifamily is not dead. Only what we're seeing in the market space right now, to find the right deal, it takes a lot of work. Must have that statistics. Last year we submitted close to 70 LOIs, got to about 3 best and final, and didn't win any deal. We reviewed over 1,000 deals just to try to find the right opportunity, but we still did not win any deal at all last year. So now as these deals are coming in, the reason why we're not winning deals is because we're very, very conservative in our approach. Like Leslie mentioned, you want to make sure you stick to those 3 laws, make sure you're buying deals in a great location and the numbers make sense. And if you don't, you better not buy a deal it's better not to buy a deal than to buy a deal that you're going to put your investors' money at risk, because at the end of the day, that's the number one priority, to preserve investors' capital. So if you're ever thinking about how we're going about our strategy, how we evaluate deals, how we look at deals, the way we underwrite deals, the way we look at market research and all of that stuff, please feel free to reach out to us, and then we can share with you all some of the strategy that we use to evaluate deal from A to Z. So yeah.
And if you have any questions, you're shy to put it to come on camera, drop it in the chat as well. Again, this is your time. Any questions you have about multifamily investing? We are about to hit like a really, really significant window of opportunity over the next 18 months. So learn as much as you can, take advantage of it so that you can build wealth for yourself and your family.
Leslie and Cindy, I know earlier y'all talked about some of the questions that a passive investor could do to vet a sponsor group. Is there anything else that they could do to ask or to look into when they're evaluating multifamily deals this year?
Yeah, absolutely. You want to get a clear understanding of what the business plan is, and see if that business plan aligns with your overall investment goal. Right. For example, a business plan might be a higher risk business plan while you are not a very high risk tolerant investor. So you want to make sure that that business plan aligns with your goals overall. What else, Tenny?
Yeah, business plan, and then you want to make sure the property is in a market that's growing. You don't want, because the reason why, like Leslie showed us on the market cycles, is you don't want to buy in a market right now that is going through hyper supply, because what's going to happen in that situation is, if you want to go in and increase rent, you won't be able to do that, because a lot of other competitors are giving concession, and if they're giving concession, it will be hard for you to kind of increase your rent, because the tenants are going to be like, listen, that other place is giving me 3 months free. Why am I going to come to yours and then pay more money? So I'm just going to go over to the other side. So you want to really kind of study the market a little bit and ask the operator to give you some more insight on why they're choosing that market. Because these deals are, you're going to hold it 5 years, 7 years, 10 years. You want to know what the projection for that market is. Is the market going to continue to grow, or is it one of those markets that are just going to stay stagnant? And if it's stagnant, what are they projecting on their rent growth, right? So a lot of these things are the things that we look at when we're evaluating a deal. Is, okay, is the rent going to stay, is the growth of the market going to stay flat, or is it going to grow up steadily? And if it's going to grow up steadily, at what rate? Is it 1%, 2%, 3%, 4%? Based on that, you want to make sure you ask the operator what their projections are, and you can go verify those information. If they're telling you that the market is going to grow by 6%, 7%, double digits market growth, like we saw in the last couple of years, you want to go verify that information. Go and say, okay, what, you can even put it on Google. You know, what is the market growth rate in Charlotte, North Carolina? They probably pop up and tell you it's probably 3% or 4%, and all of that stuff. So try to do your own due diligence as well when you're vetting a sponsor, so that of course you're trying to protect your money as well. So.
And one way to see how conservative a sponsor is to see like in an optimistic cycle that they're not necessarily going with what all that optimism is being spewed out. I'll give you an example. Like if you read market reports back in 2020 on where rent will be in 2024, 2025. A lot of the projections, even like the big projections, engines like CoStar and these other guys were showing like robust rent growth in most markets, like 8, 4, 6% in some markets.
10% sometimes, man.
Yeah, 10%.
That's how we lost a lot of deals. 10%.
And now the same data sources are showing something different. So even if a market is showing that it's going to have 10, 20% rent growth or whatever, a conservative sponsor is going to come and say, okay, I think the real number that we're going to project is going to be more around 4 or 6% or something like that.
Because you want to look at the historic growth of a lot of markets and say, okay, because what happened in COVID, there was too much money in the marketplace and markets were booming, things. So the market everywhere was hot. People had a lot of liquidity. and that's what drove inflation up. So you want to kind of look at it and say, okay, historically, what has market done? And you see that it's between 3 to 6% around that range. So whenever somebody's telling you that, oh, we're going to do double digits in our projections, you want to say, okay, let's try to see the data and see how that supports what you're projecting.
Afo Adek asks, what are some tools to utilize to look at projection values for the market? Miles, you want to answer that question for Afo?
When it comes to values, we leverage CoStar in the past, Real Pages. You can go on websites like CBRE, JLL, Cushman and Wakefield, and they send out market reports. They also send out recent closings, so you can get a good understanding of like, hey, this recent Class A property just sold for this value, and that's a good way to get like real-time data. But yeah, CoStar is what we leverage now to get some information.
Great. And there's also data, USA.io, which is a free resource that you could go. And the US Census Bureau also has some demographic data on there that you can use to look at, see if your market is growing or not.
Yeah, and if you have any specific deal and you kind of want kind of help, just don't hesitate to reach out to us. We don't hesitate to provide value as much as possible. Just reach out to any one of us, Miles, myself, any member of the acquisition team, and say, hey, I'm looking at this deal. Can you provide any insights to this and that? And we'll be able to provide some kind of insights so that you can help shape to what you're thinking and stuff like that. Okay.
We have a question.
Yeah, Leah, go ahead, please.
So when you talk about having 2 to 3% of the total cost of the property in the bank and cash reserves, how do you obtain those cash reserves if you're someone who's brand new to investing in multifamily?
That's a really good question. Leslie, you want to answer? I should go ahead.
Yeah, so you want to underwrite. It's usually anywhere from 1.5 to 3% that you have in cash reserves. You underwrite that as part of your acquisition cost going in, right? And it just depends on the kind of asset that you have. If it's like a huge reposition play, you might need to get a little bit more in reserves. And sometimes the lender too would ask you for reserves, right? So the lender will ask for a certain amount of reserves that you have to have in a bank account before they could approve your loan. So you add those lender required reserves plus the additional reserves that you're raising for the property, and just make sure that you're within that 1.5 to 2% range in reserves that you have in an account. If you're going through like a turbulent season, then you might want to have a little bit more in reserves. Again, remember, the reserves are geared towards getting you to navigate the storm, right? Because every time we go through this stormy cycle in the multifamily market, there's always sunshine at the other end. So you just want to navigate through that, and for you to deal with any surprises that come along the way.
Thank you.
So basically, it's part of your raise.
Come on, people, don't be shy.
Yeah, Leslie, I have a question.
Yes, sir.
Yeah, you talk about the financing part of it. You said is one of the key pillars of success in multifamily. And you talk about long term. What do you mean by long term? How long do you, if you see a deal, how long do you do it?
So you want to have that goes ideally 5 years, right? Because a study was done of multifamily business plans, and that looked at the failure rate of multifamily business plan and tracked it versus the duration of how long they were held. They found that there was a failure rate of about 30% or something for deals that were held just for 3 years, right? When you stretch it to 5 years, the failure rate dropped by almost half, about 15% failure rate. And now when you went to 10 years, the failure rate was negligible. It was less than 2%, right? And if you think about it, the reason is because these assets, the value is based on income, right? Over a 10-year period of time, rent will go up. Like, even if it's very rare for like a market to be in a cycle where for 10 years you have no rent growth, right? So as rents grow up, the income is going to increase. And then over those 10 years, you're paying down the debt, which is mean you're paying down the principal. So your net operating income is increasing. So time is a crucial factor when it comes to multifamily investing. Time can really save you from any not making the right decision. So when you're looking at debt, you want to have debt that is ideally 5 years, right? Or if you have a debt that is shorter, there's a reason for that, and there's a plan in place on how to deal with that once that debt expires.
Thank you.
You're welcome.
Fairly
Leslie,
to give like 5, 7, 10 years term deal on their debt as well, so you can get all the way to 10 years term on a lot of those debts. So you want to make sure you leverage that when you're buying these deals.
hey, Leslie, can you talk about how you should be aligning your debt with your business plan?
Absolutely. So
Yeah.
if you have a distressed deal, right, that you want to stabilize and exit, we might be looking at a shorter term debt, right? Because that means if you have a long term debt on it, and when it's time to exit, you're gonna have to pay a prepayment penalty, and that could be significant, right? Because most of this debt for multifamily asset, it usually has like an interest only period. So if you exit out too quick, the lender wants to recover some of the benefit that they were going to get from you holding long term that they did not get. So they're going to charge you a prepayment penalty. But now if you have a more of a deal that is a longer term hold, right? Maybe like a longer term stabilization play, like a value add where you got to do renovations over 3 to 5 years. Yeah, you want to do a longer term 5 to 7 to 10-year debt, right? And even when you do that, let's say if you do a 10-year debt and then you do your business plan over a 5-year exit, you want to make sure you factor in the cost for exiting out of that debt, right? And typically that cost decreases the longer you hold the property for. So you gotta look at your that's where underwriting a multifamily asset is very important, because you're gonna look at all of this and estimate all those costs and see how that affects your returns. If you're still making great returns, then you could do you could go whatever strategy you want. So, but again, the longer the business plan, the lesser the risk, right? So, but then that's not to say shorter term business plans are not great. For example, if you find a destabilized asset in a good market, you could do a short term business plan, stabilize it really quickly, and refinance into a longer term debt, or you exit and make a good profit.
Hey, thank you, sir.
Yeah.
Hey guys, curious to know what kind of markets you're into, what regions you're looking at these days, and why do you like them?
Absolutely. We still are heavy on the Southeast, Jacob. We're looking at North Carolina, South Carolina, Georgia, and we started looking in Texas as well. Again, these are markets that we've been highly involved in over the last 5 years. In our southeastern regions, we're starting to look outside of our primary markets. Like we're looking outside of Charlotte to like secondary markets and tertiary markets like the Gastonia, Lincolnton areas. Those are markets that are outside of Charlotte that are doing really well right now. Charlotte itself is overbuilt, it's hyper supplied. So there's some challenges there with the occupancy. But what we're seeing in those outside markets is like robust occupancy, even some rent growth in some of those markets. So we're looking at those little markets outside of the primary areas to invest in. We're looking in Texas as well. Some primary markets in Texas, because Texas is one market that has gone through like that provide some markets in Texas provide a very unique window of opportunity right now, because Texas is one market that's going to see a lot of these distressed assets. Here's the reason why, right? Houston was booming. A lot of deals were being sold in Houston, right? With this short-term bridge debt, right? A lot of that debt, the cap on it is expiring over the next 12 to 18 months. And Houston is one of those markets that suffered the most from the insurance hikes, right? Houston is one of those markets where the insurance costs actually tripled. So now you had somebody that went into a property underwriting a debt cost of about 5% and an insurance cost of maybe 500. Debt cost has gone up to 9%. Insurance cost has gone up to 1,500. So a lot of operators are just handing over their keys. But guess what? Houston still has very strong fundamentals. Population is growing over there. It's one of the fastest growing cities in the US, right? I think Houston is part of whatever, there's a triangle, I forgot the name they gave it, but it's like the fastest growing region in the world when it comes to population and like your companies and stuff. So it's part of that triangle. So while you hear the distress news, don't get distracted by it. Like look at the fundamentals of that market, and then you could go in there and create some great opportunities. Dallas is another market that we're looking into as well. That's a market that was really overpriced over the last 3-4 years, but now we're starting to see those prices come down significantly. And Dallas has fundamentals for long-term growth as well. So if you hear what I'm saying, you will hear fundamentals, long-term growth. And so those are some of the things that we look at in these markets that we are focusing on. Tenny and Miles, I don't know if you guys want to add anything else on the market.
Yeah, you pretty knocked it out the park with that. Just if we are looking at like the Charlotte area, like Leslie mentioned, we're looking at the secondary, tertiary markets that are gonna benefit from all the families, all the individuals moving to those primary markets. Along with North Carolina, South Carolina, and Georgia, those are our primary markets that we target. Leslie mentioned Texas. We also look in Tennessee, Virginia, Maryland, so going all up the mid-Atlantic. Florida, we look at deals in Florida, but Florida, like Leslie was mentioning, how Houston was struggling with the insurance rates. Florida and anything along the coast, you're going to see high renewal rates and insurance. So we're tentatively looking in deals in Florida as well, Jacob.
Cool. Thank you.
You're welcome. There's a question here from Alfu. Tenny, I'm going to let you take this one.
Yeah.
Is Excel Capital just an investment avenue for passive investors, or do you work with individuals that may have leads in pursuing opportunities and splitting the profit, or it's a hybrid of both? Just curious.
So
Alfu might have a deal for us, Tenny. So
I wish I did.
So what we've observed is that a lot of people right now, Excel Capital is created to work with investors, passive investors, to help them grow their wealth. And then what we realize is a lot of people want to be able to do the same thing. And this year, we launched a mentorship program to help guide people that wants to do it. So instead of us to say, okay, bring your money, let's go do it, come on, join our deal. We want to actually teach you how to do it so that you can go do it yourself. So that mentorship program that we created is to serve that purpose. Now, there are some unique opportunities that could arise in the future where you say, okay, I have a deal. I want a JV with Excite Capital to take it down. Where I don't know how to do it, but I want Excite Capital to take lead. We can discuss those options for the future. But for right now, what we're focused on is helping investors grow their wealth, and then helping those that want to create a company like Excite Capital. We're showing them how to do it. So that is how I would answer that. I don't know, Leslie, if you want to add something to it.
I think you hit the nail on the head. And there's a question from Chima that says, what are some basic key indicators or metrics investors should monitor to determine if multifamily real estate is still a viable investment option?
So investment metrics. So one of the things we talked about is like the rent growth. So if you take a deal, you dissect the deal, you want to see if the deal is cash flowing, right? Day number one. Is the deal cash flowing after you've done your magic on the deal, you've gone on the right deal? Is it still cash flowing? If the answer is yes, then that's a good one, right? Two, you want to see, does the operators, are they projecting a significant rent growth compared to what's actually happening in the market? Because that's how they make numbers. Because like Manny always say, he's on the call, he always say, operators, they can put anything that they want on the spreadsheet to make it do what they want. But at the end of the day, is that the fundamental? Is that what's actually happening in the market? Are they getting feedback from the property managers? And are they using data? So you want to look at the rent growth in that market as well, both organic and potential rent growth when you do value add. Also, you want to look at the debt, what kind of debt they're using, the LTV that they're using, that's the loan value, loan to LTV, as it's called, loan to value. That's what it's called. So you want to check that to see, are they, finally, would I give you too much leverage right now because of what's going on in the market? But in 2021, 2022, Some people were getting 76% leverage on Fannie and Freddie, and then some people were getting all the way up to 80 to 90% leverage on their deal. And one of the things you don't want to do in multifamily real estate is over leverage, because if you over leverage, the bank easily take the keys when stuff hit the fan, right? So those are some of the things I would say you want to look at. Manny might be able to answer some more questions in that regard, or Leslie, if you want to add some more insight to it.
Yeah, I can jump in. One of the things, especially right now, you want to look at, if you have a business plan and you look, it depends if you're an investor or you're the sponsor. If you're an investor and you're looking at a deal, you want to see if the business plan is viable. For example, if they tell you they plan on increasing rents, you want to look at the tenant demographic, like the median home income in that area. Does this support that business plan? And also just comparing the cost to the expense to own a home versus renting, because remember, if tenants have the option to own, they're gonna own. But so if you're in a market where the cost to own a home is significantly higher than to rent, then that's a viable market for renters. So that's like some things that a lot of people don't pay attention to. But in addition to everything Tenny mentioned, but those are a few. There are a couple other things as well, but I'll leave it at that.
That's a very good question, Chima. How is the current inflation and projections affecting return rates in multifamily investments based on your current evaluation of market trends and your real-time values? So inflation is actually tapering down, Afu, and you're going to see in the next report that the Fed would release, you will show that inflation has come down. There's some talk about the data that was used for rents in the last inflation report is incorrect data. But what we're seeing across multifamily markets is actually a decline in rent. Which is contrary to inflation. We're seeing, and rents are a good projector, a good indicator of inflation, right? Because one of the quickest things that we saw before the Fed actually admitted that there was inflation is our rents were skyrocketing. In most markets, they were going like really high. Then there's always a lag with the Fed catching up and saying, oh, now every other price is going up. But rents are usually one of the first indicators. And right now, what we've seen over the last 6 months, 3 to 6 months, is like a decrease in rent in most markets or flattening in rent in most markets. So that says that inflation is tapering down. So what that means is, again, this is a numbers business. You just factor in those numbers and those projections for the next 2 years, and you determine what the value of that property is. Again, it's not guesswork. Everything is underwritten based on the numbers. Is the income that property is able to produce, that is what determines the price. So that's how we use the current rent numbers to be able to determine the value of each property. I hope that answered your question, Afu.
Yes, sir, it did. Thank you.
All right, it's 7:08. If anybody else wants to come on camera, introduce themselves, say what they're doing, and this is an opportunity. We really promote collaboration and sharing of ideas with each other on this platform, because we know that's how we grow, by being able to build each other up. So wherever you are on your journey, if you want to talk, come on camera, share it, to collaborate with others, now is your time.
If you want to network too, just give an insight to what you're doing. We definitely would love to kind of just chat and get to know you more.
So this is Dalton Ogunwale. I just want to say thank you to the team. I've been following you on LinkedIn on your daily nuggets that you're putting in. So thank you so much. I've been really, really enjoying it, and it's been very helpful and impactful for me, and you're also helping me to see the bigger picture of why I'm managing my own multifamily business. So thank you.
That's amazing, man. Thank you so much. I appreciate you for being here. Anybody else? Don't be shy.
Do you guys want to say one or two things?
I'll go ahead. Jacob Gabriel. I work in multifamily lending. Like Dotan, I followed you guys on LinkedIn, saw some great content. You guys really, have a finger on the pulse of the industry. So it's great to listen in on. you know, being in lending, happy to talk to anybody who's interested in hearing more about maybe what I'm seeing in the market or anything to that effect. So thanks for having me. It's great to be here.
That's amazing. Guys, you hear that? Jacob is in lending. So if you need somebody to look at your multifamily property and provide a debt quote, connect with Jacob. Jacob, you want to drop your email or contact in the chat for anybody that
Yeah,
wants to touch base, please?
absolutely.
That would be
Yeah.
great. Thanks. Anybody else? All right. Today was a more small and very intimate crowd, and I love it. If we don't have any other questions or anybody looking to introduce themselves, we're gonna wrap it up. Just gonna say thank you all for taking the time out of your schedule to be here with us today. And please reach out to us if there's anything that you want to learn, anything that you'd like for us to talk about that will bring more value to you. Again, this platform was created to give value to our community and to educate members of our community about multifamily investing. Before I wrap up, Jacob, would you be open to doing a presentation about maybe the update of lending in the market or what's going on right now with the debt market?
Right now?
No, not right now. Maybe maybe one of our subsequent meetups.
Yeah, absolutely. I'd love to.
All right. So we'll touch base with you and then we'll set something up.
Okay, sounds great.
All right. All right, everybody. Have
All right,
a
guys,
wonderful
thank you so
night.
much for joining. Take care,
All right.
everybody.
Good
Thank
night.
you, guys. Have a good night.
Thank you. Have a good one.